Stop what you're doing right now. Put down that television remote, inform your spouse that the household chores can wait, and if you absolutely must head to the restroom, take your smartphone with you and secure the door. The information regarding the sheer institutional hysteria currently unfolding across Wall Street trading desks is so incredibly time-sensitive that every other priority in your daily life has effectively become secondary. We need to have a serious conversation about the phone calls that are being made right now, and I require your undivided attention for at least the next 10 minutes. Over the course of the previous 48 hours, communication channels have been absolutely overwhelmed with data. Consistent reports are coming in from private wealth management clients, from high net worth investors based in financial hubs like London and New York, and even from standard retail participants who maintain substantial holdings in their personal brokerage portfolios. In every single piece of correspondence, the narrative remains identical. They are reporting that their financial brokers are taking the initiative to reach out to them directly. Now, if you have any significant experience in the financial markets, you understand that a broker typically only initiates a call for one of two specific reasons. Either they are attempting to pitch you a high-commission product that serves their interests rather than yours, or they are issuing a margin call because your account equity has vanished. It is historically unprecedented for them to call you out of the blue just to offer altruistic, profitable market advice. Yet, inexplicably, throughout this week, the telephone lines are buzzing incessantly. Very specific institutional names are being mentioned in the rumor circles, and the prepared script these brokers are utilizing is virtually indistinguishable across the board. This is not a random occurrence. It is a highly coordinated and surgically precise campaign. These firms are specifically targeting investors who have demonstrated the fortitude to hold physical or paper silver through the most difficult years of the market. They are calling people who entered positions at $20, maintained their conviction as it climbed through $30, and are currently looking at life-changing profits with the price sitting at $80. The message they are delivering is that the bull market has reached its conclusion and that it is time for you to liquidate your position immediately. However, they are not merely suggesting that you harvest your gains, which would be a standard piece of investment advice. Instead, they are pushing much further by actively encouraging their more aggressive clients to consider opening short positions against the metal. They are aggressively marketing put options and pitching inverse exchange-traded funds. They are effectively advising their own clientele to bet against what is arguably the most powerful bull market cycle we have witnessed in an entire generation. Furthermore, the vocabulary they have chosen for these calls is specifically engineered to trigger a primal fear response. They aren't utilizing mild terminology such as market correction or temporary consolidation. Instead, they are deploying emotionally charged words like meltdown and structural liquidity crisis. These professionals are looking grandmothers and retirees in the eye, so to speak, and asserting that a massive, inevitable price collapse is guaranteed to decimate the silver market within the next 72 hours. They are warning that if these investors do not sell their entire holdings immediately, they will wake up to find their wealth has evaporated. They are constructing a terrifying narrative of a catastrophic market flush intended to erase every bit of progress made during the 2025 rally in the span of a single trading session. Take a moment to pause and reflect. Step away from the immediate emotional reaction of fear, take a calming breath, and begin to analyze this situation with the mindset of a criminal investigator. Ask the most fundamental question in the world of high finance. Cui bono? Who actually stands to benefit from this? Since when did the massive international bullion banks start prioritizing your personal financial prosperity? Since when did they spend their valuable time calling you to help you perfectly, time the peak of a market cycle, so you can maximize your personal fortune? They certainly didn't pick up the phone when silver was undervalued at 18 to tell you it was a once-in-a-lifetime buying opportunity. During that period, they were completely silent, or worse, they were issuing research papers claiming the price was headed toward 15 nur. They didn't reach out when the price surged past the 50 mark. But now, at the dawn of 2026, with silver trading at $80 and moving aggressively higher, with COMEX inventories being depleted at record speeds, and the price spread in Shanghai widening to extreme levels, they suddenly want to be your closest allies. They are suddenly expressing deep concern regarding your exposure to downside risk. Make no mistake, this is a sophisticated psychological trap. They are not contacting you to protect your capital. They are contacting you to safeguard their own survival. These institutions are in a state of desperation, trying to fabricate a pool of sellers because they are in dire need of buyers to take the other side of their trades. You must grasp the basic reality of market mechanics. For every person selling an asset, there has to be someone on the other end buying it. If these brokers are telling the entire world to sell, who do you think is waiting in the wings to purchase that silver? They are. They are attempting to incite a tidal wave of retail-driven panic selling to generate the necessary liquidity they require to close out their own disastrous short positions. They are essentially trapped inside a burning skyscraper and are trying to convince you to run into the flames so they can use you as a human shield to dampen the fire. These banks are likely sitting on short positions totaling 4.4 billion ounces of a metal that is physically vanishing from global storage vaults. Every single dollar the price goes up costs them billions in margin calls. They are hemorrhaging cash, and the only strategy left to stop the bleeding is to manipulate you into throwing away your winning hand. They desperately need you to trade in your winning lottery ticket for a few cents on the dollar so they can cover their liabilities before the true price explosion occurs. The specific tool they have selected for this psychological operation, the terrifying boogeyman they are using to scare you out of your hard-earned wealth, is a dry, technical, bureaucratic process that the vast majority of the public has never heard of. They are shining a spotlight on a specific calendar event known as the BCI rebalancing. They are treating this rebalancing event like a loaded weapon, asserting that it will cause a $6 billion liquidation that the current market will be unable to handle. They are pitching this to you as the definitive catalyst that will break the back of the current bull run. But we have to ask, is this a genuine market meltdown, or are we witnessing the most elaborate bear trap set in the last several decades? To see through the deception, you have to first recognize the small grain of truth they have buried within the lie. The BCI is a real entity, but the story they are telling about it is a total fabrication. To tear down this falsehood, we must examine the specific mechanics they are using to frighten the market. Because this isn't some supernatural legend. It is a functional gear within the global financial system. We need to discuss the Bloomberg Commodity Index, commonly referred to as the BCI. To the casual observer, this sounds like uninteresting financial terminology, just another random string of letters on a news ticker. However, for the world of big money, the massive sovereign wealth funds in places like Norway, the multi-billion-dollar pension funds in California, and the elite university endowments at institutions like Harvard, the BCI is the ultimate authority. It is the foundational benchmark for all commodity-based investment strategies. It functions as a massive, passive, algorithmic entity that dictates the movement of approximately $108 billion in total assets. Contemplate that figure for a moment. $108 billion. This is dumb money in the sense that it doesn't utilize intuition. It doesn't perform technical analysis on charts. It doesn't monitor the daily news cycle. And it is completely indifferent to silver mining strikes in Mexico or the surging industrial demand for solar panels in China. It is purely mechanical capital. It simply maintains a specific basket of various commodities based on a rigid set of mathematical rules established by analysts in New York. Because it is an automated system, it adheres to a very strict schedule. It doesn't just decide to become bearish on silver on a whim. It only executes trades when its underlying software code dictates an adjustment. The most critical instruction in that entire software package is the annual January rebalancing. Every single year during the initial weeks of January, this $108 billion algorithmic giant performs a system-wide maintenance check. It evaluates its entire portfolio, which includes everything from Brent crude and soybeans to coffee, gold and silver, and it must recalibrate the percentage that each commodity represents in the total basket. It is required to ensure that the actual dollar amount invested in each sector aligns perfectly with the target weightings established for the new calendar year. This is a cold, mechanical, and entirely automated process that cannot be avoided. This is the specific bureaucratic reality that brokers are using to shout at you through the phone. They are making noise because the target weightings for the year 2026 have shifted. The committee that oversees the index has mandated that silver's target percentage must be reduced. They have officially decided to scale back the index's exposure to the metal. To be precise, the target weighting for silver is being lowered from last year's level of roughly 4.49% down to a new threshold of approximately 3.94%. On the surface, if you don't know any better, this looks like a massive looming sell order. Brokers are pointing at these technical documents and yelling, "Look, the algorithm is programmed to dump its holdings. The largest whale in the entire commodities sector is about to liquidate. You have to sell your silver before the robot beats you to it." They are characterizing this as a fundamental rejection of silver's value. But that is where the massive deception lies. The algorithm isn't selling silver because it has lost faith in the metal's value. It is selling because silver has been too successful. The index operates under strict diversification rules and caps. It is legally not permitted to allow any single commodity to grow so large that it dominates the entire basket. Because silver had such a spectacular performance throughout 2025, outpacing almost every other asset class on the planet, its total value within the fund grew too large. It started occupying an outsized portion of the portfolio. Consequently, the internal rules dictate that it must be trimmed, or pruned back to its original intended size. This selling is actually the penalty for winning, but the brokers aren't explaining that context to you. Instead, they are promising a meltdown, They are claiming that this administrative adjustment is going to set off a chain reaction of selling that will permanently end the silver bull market. They are taking a boring, dry rule change and weaponizing it psychologically to create panic. To make the fear feel tangible, they are throwing around massive, scary dollar amounts. They whisper that because the fund is so colossal, $108 billion, even a fractional percentage change results in a mountain of selling. They ask you, if this giant starts dumping billions in silver, who's going to be there to catch the falling knife? They claim it will utterly destroy the buy orders and wipe out the entire market's stability. This is the narrative they have carefully built. It is dangerous because it is built on a sliver of truth. The rebalancing is indeed happening and the selling is indeed mandatory. However, the conclusion they want you to reach, that this necessitates a market crash, is a lie predicated on intentionally deceptive mathematics. This is where we catch them in the act, because if you actually take the time to perform the calculations yourself and look at the data they are trying to obscure, you realize the situation is being completely misrepresented. There's a very specific mathematical error spreading across social media platforms like Twitter and Reddit right now. You'll see people saying, oh, the target is only moving from 4.5% to 3.9%, which is just a 0.5% shift. That's only 600 million. Why is everyone so worried? The brokers actually love that people are thinking this way because they want you to stay confused. The reality is that the people claiming it's only a $600 million event are wrong, and the brokers claiming it as an unmitigated disaster are lying about the timing and nature of the impact. We need to clear the air and do the actual math together right now. We need to figure out exactly how many physical ounces are actually slated to move, because the figure isn't $600 million. It is nearly 10 times that amount. Once you see the true scale, you will understand why the banking institutions are so desperate to trick you into selling your position. Let's break down the $6 billion reality. You cannot simply take last year's target and subtract this year's target to find the answer. That is elementary school math, and in the high-stakes world of professional commodity trading, that kind of oversimplification will get you financially ruined. The "don't worry" crowd on social media is ignoring the most vital variable in the entire formula, price appreciation. They are completely ignoring what silver actually achieved during the 2025 calendar year. Think back to the start of last year. Silver was a quiet part of the basket, sitting at its assigned percentage. But then the explosion happened. Silver didn't just rise, it went on a historic tear. It moved from $30 to $40, then to $60, then to $80, more than doubling in its total market value within 12 months. Imagine you have a pie chart representing different investments. If one specific slice of that pie doubles in its total size, while the other slices, like oil, corn, or wheat, stay the same or even shrink, what happens to the overall chart? The winning slice expands until it starts taking over the whole plate. By the time we reached the end of December 2025, silver was no longer occupying just 4.5% of that $108 billion fund. It had ballooned. The actual effective weighting of silver within the fund had surged to nearly 9% of the total assets. So when the rebalancing algorithm resets in January, it doesn't look at the targets from a year ago. It looks at the current reality of the portfolio. It sees that silver is currently taking up 9% of the room, but the rulebook strictly states it is only allowed to have 3.94%. Do the math on that difference. The robot doesn't just have to sell a tiny 0.5%, it has to liquidate the massive gap between 9% and 3.94%. It has to dump approximately 5% of the entire $108 billion fund. It essentially has to amputate half of its total silver holdings to comply with the regulations. Now, let's put a specific dollar value on that, because this is the number the brokers are using to terrify their clients in private. If you take 5% of a $108 billion fund, you are looking at a total sell order of approximately $5.4 billion to $6 billion. That is not a minor event. That is a market-moving leviathan. If you translate that dollar amount into paper contracts at today's market prices, you're talking about roughly 70 to 78 million ounces of silver that the index is required to puke out in a very narrow time window. That represents nearly 10% of the entire planet's annual silver mining production being dumped in just a few days. This is precisely why the brokers sound so incredibly confident when they call you. They aren't lying about the sheer volume. They are looking at the spreadsheet on their screens. They see this $6 billion wall of selling crashing toward the market. And they are telling you that standing in front of it is financial suicide. They are using this massive, undeniable number to convince you that a price collapse is the only possible outcome. They are gambling that the market's underlying structure is too weak to absorb a 70 million ounce sale. If you only looked at this single side of the ledger, you would likely agree with them. You would probably panic and sell. But this is where the trap is set, Because in the world of professional finance, volume does not always equal price impact. Just because a whale has to sell $6 billion worth of an asset does not mean the price has to crash today. The outcome depends entirely on when they sell it and who already knew that the sale was coming. And this is the deep secret that firms like JP Morgan and Morgan Stanley are desperate to keep from you. They are acting as if this $6 billion order is a total shock to the system. They are pretending it is all hitting the market right now, this very week, all at once. But ask yourself, does a professional fund manager responsible for $100 billion really wait until the very last second to execute the largest and most important trade of the year? Or are they playing a much more strategic game? We need to reveal the actual timeline and discuss the concept of front running. We need to explain why this supposed crash is actually an event that has already occurred. You have to ask yourself a very basic question about how markets function. If you knew with absolute 100% mathematical certainty that a massive entity was going to dump a huge amount of silver in January, would you sit around and wait until January to do something about it? If you were a high-frequency trader at Goldman Sachs or a predatory hedge fund manager at Citadel and you saw the BCI announcement way back in October of 2025, would you really just sit on your hands for 3 months? Would you wait for the price to drop before you exited your own positions? Of course not. In the world of professional trading, waiting is the same thing as losing money. The very second that report was made public in October, the moment the target weight was officially cut to 3.94%, the smart money began to move. They started front-running the rebalance. This is the hidden reality of the index world. The BCI rebalance is not a surprise. It is the most well-publicized and telegraphed move in financial history. Every professional knows the date, the size, and the direction. Because of this, the active fund managers, the guys who run funds that follow the index but have the flexibility to trade ahead of it, didn't wait for this week to arrive. They spent the entire month of November selling into the market's strength. They spent December offloading their positions as the rally continued. They slowly and methodically liquidated that $6 billion worth of exposure while the price was surging. They used the high demand of the bull market to mask their exit, feeding the ducks while the ducks were still hungry. Consequently, by the time we reached January 8th, 2026, the moment your broker is calling you to scream about a meltdown, the vast majority of that actual selling pressure has already been processed by the market. It has been absorbed. The reason silver didn't skyrocket to $100 back in December, the reason it took a breather and consolidated at 80 was specifically because this $6 billion sell-off was happening quietly in the background. The market has already consumed the meal. It is digesting it as we speak. So what is actually left for this week? What remains of this catastrophic crash? Only the dumb money is left. The strictly passive ETFs like the iShares Commodity Trust or the DJP fund. These are the funds that are legally barred from trading even a day early. They are required by their charters to trade exactly on the rebalance date. But these specific funds are relatively small compared to the total pool. They represent perhaps only 2 or 3 billion of the total amount. They are the tail of the dog, not the dog itself. This reveals the true predatory nature of the broker's phone call. If the major banks like JP Morgan know that the smart money already exited in December, and they know that only a few passive robots are left to sell today, why are they telling you to go short right now? It's because they want you to sell at the very bottom of the dip. They want you to witness the minor selling from these passive robots, which might push the price down $1 or 2 for a few hours, and mistake it for the start of a massive crash. They want you to panic sell your holdings into a market that is already priced in the entire event. They are effectively trying to get you to provide the necessary liquidity for the same active managers who are now looking to re-enter the market. Think about how the cycle works. The smart money sold in December at $85. Now, the passive robots are forced to sell at $75. Those same smart money managers are now sitting on piles of cash, waiting to buy back those discounted shares from the robots and from you, so they can ride the next leg of the bull market higher. Your brokers are simply helping them complete that cycle. They are recruiting you to be the loser in a game of musical chairs that actually ended 10 minutes ago. This is why the entire meltdown narrative is a hoax. The $6 billion volume is a real number, but the timing they are presenting is a lie, and the impact is a past tense event, not a future one. We are looking at something that is already in the rearview mirror. While the Western world is distracted by this paper-shuffling drama and New York traders are obsessing over basis points, there is a massive force in the East that couldn't care less about the Bloomberg Commodity Index. There's a buyer out there who doesn't use high-frequency algorithms. They use massive cargo ships. And this buyer is viewing this temporary dip not as a reason to panic, but as a massive clearance sale. We need to shift our focus to the bullish reality of the China shield. We need to understand why every single ounce of silver that the New York robots are dumping onto the market is being immediately swallowed by a dragon. Let's examine the arbitrage reality and why this dump is guaranteed to fail. This is the exact point where the banking cartel's plan completely falls apart. Their sophisticated paper market manipulation is about to slam into the unbreakable wall of physical reality. While New York is worrying about target weights, there's a physical monster in the East that is consuming every ounce of silver it can find. We have to discuss the China Prios, China Shield, and the single most critical number in the global silver market today. It isn't the price you see on your local ticker, it is the price difference between your screen and the price in Shanghai. As we speak, the Shanghai Gold Exchange, the global center where physical metal actually changes hands, is trading silver at a massive premium compared to the COMEX in New York. We are currently seeing a price gap of nearly $7 per ounce. Do you grasp the economic physics of that? It means a bar of silver increases in value by $7 the moment it moves across the ocean. It is an arbitrage trader's paradise. It is essentially free money. If you can purchase silver in New York for $75 and immediately sell it in Shanghai for $82, you don't just do that trade once. You do it as many times as possible until the vault is empty. Now consider what this BCI rebalancing actually does in this specific environment. The New York robot comes in and dumps $6 billion worth of paper silver onto the market. This temporary surge in selling pressure naturally drags the New York price down. Let's say they successfully push the price from $80 down to $72. The brokers celebrate, and the short sellers think they've won. But what have they actually accomplished? They haven't lowered global demand. They have simply put the physical metal on a flash sale by depressing the New York price while the Shanghai price remains high. They have effectively widened that arbitrage gap from 7 all the way to 15. They have turned a profitable trade into the greatest financial opportunity of the century. They are literally subsidizing the Chinese government's accumulation of silver. Every time the price dips in New York, the industrial vacuum in the East turns on to its highest setting. Arbitrage traders, international banks, commodity houses, and Chinese state-owned enterprises all look at that 72 price tag and start buying everything they can touch. They scoop up every ounce the BCI robots are selling, take physical delivery, load it onto ships, and transport it to China. The dump that your brokers are warning you about is actually a massive gift to Beijing. It accelerates the drainage of Western vaults and speeds up the very supply shortage that will inevitably drive the price much higher in the long run. The BCI rebalance is effectively a mechanism for transferring wealth from Western pension funds, who are being forced to sell at the bottom, to the Chinese government, which is more than happy to buy the dip. And why is China buying with such aggression? Why is there a physical floor under this market that simply refuses to break? It's because China isn't trading for a quarterly profit report. They are trading for their long-term industrial survival. They currently control 80% of the world's solar panel manufacturing capacity. They are fully aware that without silver, they cannot produce those panels, and without those panels, they cannot achieve their goals for energy independence. They are looking at the same geological data we are, and they see that mine supply is cratering. So, when they see a rebalancing event, when they see a foolish Westerners selling their silver because a rule book told them to, they don't panic. They laugh, and then they buy everything. This is the China Shield. It is an impenetrable wall of buy orders sitting just below the current market price. It guarantees that any price drop caused by this rebalancing will be shallow and very short-lived. It is impossible to crash a market when the world's most aggressive buyer is standing there with an unlimited budget, hoping for a discount. If you follow your broker's advice and short the market now, you aren't betting against a price bubble. You are stepping directly in front of a high-speed freight train known as the People's Republic of China. You are betting that a paper-based algorithm in New York has more power than the actual industrial needs of the second largest economy on Earth. That is a losing bet. The banks know this. JP Morgan is well aware that the price spread exists. They are likely the ones profiting from the arbitrage. But they need you to be the patsy on the other side. They need you to sell your physical metal or your ETF shares so they can use that liquidity to cover their massive short positions before the price inevitably snaps back. They are using this rebalancing story as a smokescreen to hide their genuine terror of what is happening in the East. They know that once this $6 billion window of selling closes, there is no more new inventory coming. The passive funds will be tapped out, but the Chinese demand will still be there. That is when the real price action begins, when the market stops following New York and starts following Shanghai. We have now thoroughly exposed the broker's hoax. We have corrected the deceptive math. We have revealed the front running that happened in December, and we have identified the massive buyer of last resort. What is the final conclusion? What should your response be when that phone inevitably rings? We need to conclude this with your specific marching orders for the rest of this week. Let Des finish this exposure and tell the banks exactly what they can do with their meltdown predictions. You must keep the most important statistic of this entire saga at the forefront of your mind. the one number that keeps the risk managers at JP Morgan from sleeping at night. They are short by 4.4 billion ounces. They have sold promises they cannot fulfill. They have sold metal they do not actually possess. And now, with silver prices breaking through $80 and global inventories vanishing, they are staring into a total default. They are in desperate need of a miracle, and this BCI rebalancing is the only miracle they have left. This is the only scheduled event that provides a guaranteed wave of selling. It is their final opportunity to create enough noise, fear, and confusion to mask their own exit from the market. They are hoping that if they scream meltdown loud enough, you will lose your nerve. They are hoping you will see a red candle on a chart, triggered by a mindless robot, and believe it is the end of the world. They need you to be their liquidity. They need your shares, your contracts, and your physical bars, because if you don't sell to them, they will be forced to buy from China at $90 or $100. They are essentially begging you for a bailout. So here is my definitive advice for the week of January 8th, 2026. When that phone rings, and you see your brokerage firm's name on the screen, and they start reading that script about downside protection and rebalancing risks, just hang up the phone. Do not engage with them, do not argue with them, and absolutely do not sell your position. Do not allow them to manipulate you out of the only asset that is truly immune to the ongoing debt collapse of the Western financial system. Do not trade your real, sovereign wealth for their failing paper promises. You must have the internal discipline to look past the next 48 hours of volatility. The rebalancing window is already closing. The robot is nearly finished with its selling. The dumb money has almost finished panicking. As soon as that artificial selling pressure is removed, which is a matter of days, not weeks, the weight is lifted. The beach ball is released from underwater. The price will not just recover, it will snap back with a level of violence that will utterly destroy the short sellers. We are looking at a slingshot move that will carry us past $80 and open the path toward triple-digit silver. The underlying fundamentals have not changed. The mines are still struggling, solar demand is still rising, and the dollar is still losing value. The only variable that changed was a single line of code in a Bloomberg index, and that code is completely irrelevant to the objective laws of supply and demand. This is a classic game of financial chicken. The banks are revving their engines and flashing their lights, driving straight toward you in the hopes that you will flinch and swerve. But their car is made of flimsy paper, and your tank is made of solid silver. If you refuse to move, they are the ones who will crash. If you maintain your position, their 4.4 billion ounce short position will explode. This has transcended being just a simple trade. It is now a historic transfer of wealth. This is the wealth of the market manipulators being forcibly transferred into the hands of the investors who refuse to be shaken. Be stubborn. Be the immovable object. Do not let yourself be a victim of this meltdown hoax. Instead, be the one who benefits from this rebalancing sale. If they manage to push the price down to $75, view it as a favor and buy even more. Because in 6 months, when we are trading at $150 an ounce, you won't even remember what the BCI was. You will only remember that you had the courage not to let them steal your future. The hoax has been exposed, the target is set,